Humans are very interesting species. They always need food, like everything else. Let's go. Hello everyone, my name is Alex. Welcome to my channel. I hope you're doing well. I hope you're staying safe and hungry, or not hungry. Today is going to be another episode of the best high dividend stocks per sector, and we're going to be diving into the food sector or consumers defensive sector. This is actually one of the most interesting sectors right now during this whole market craziness that's happening since last March, and also it has to be a part of the every single investment portfolio. You know why? Because everyone needs to be fat. Yo, we're so weak, we can't live without the food. Interesting, right? Some of the stocks in this sector didn't even blip during the last year market crash. They just keep sailing upwards and getting all those returns back. And this is exactly why diversification is very important. You have to have all different sectors in your portfolio so you can benefit from all different types of market situations. So the stocks we're going to be talking about today are appreciating value at the same level as some of the tech stocks, which is wow. And moreover, you can expect their dividends to be growing consistently for the next at least 10 years or so. And also you can expect that in the future, the dividend payments being increased as well. These are the companies that are still growing super fast, and they're starting to add dividends very recently. And the moment they can see this sustained growth over time, they'll increase and they'll improve those dividends for sure. And right now is one of the best times you can add these stocks to your portfolio. You know why? Because the second the lockdown is over, the second we go back to the market and start buying stuff, where are we going to buy this stuff? From all these companies we're going to be looking at today. People are shopping crazy today because there is nothing else you can do. You're just staying home with your locked door. There's nothing you can do, just shopping. And the moment the lockdown is over, the moment you can go outside, you will go to the park. No, you will go to the shop, the actual physical shop, and start shopping. That's what people are waiting for, and that's what's going to happen. Let's take a look at the best high dividend paying companies we have today in the consumer sector. And the first one is Empire. The ticker symbol is EMP-A.TO. And this is the company that controls and owns all other companies that we know and use every single day. Companies like Sabis and also Longos. As of just recently, they purchased 51% of Longos. And this is crazy, right? So they have all these big players underneath themselves. And investors actually like what's happening with Empire right now. Besides all the acquisitions and mergers this company is going through, they're also crazy in terms of the growth. Over the last 5 years, returns on capital employed rose substantially by 11%. This is crazy. Basically, the business is earning more per dollar of capital invested. And moreover, 56% of capital reinvested is now employed. So the way the company is reinvesting back to their business is crazy. They're so smart in terms of what they're doing with their money and how they use to grow their business. Which is great for investors, as you will see a lot into market appreciation, and also at some point they'll start increasing their dividends as well. Let's take a look at our metrics now. The market cap is at $10.6 billion. The dividend yield is at 1.3%, which is not great actually, but the company been increasing their dividends for the last 26 years. So they're on the route of becoming a great dividend company in the future. The payout ratio right now is super sustainable, is around 20%, and as I just said, they're reinvesting all their earnings back to their business in order to grow it, and they're doing that great. The 10-year share price appreciation is 121%. And if you take a look at the last year market crash and where this company was and what happened to it, they actually didn't know the market crash happened. They're still flowing upwards without noticing any sort of problems. And of course, one of the reasons why that happened is just because the reason of this market crash, of the pandemic and all this virus and all that, where the people had to buy groceries all the time, and they will keep buying them all the time because people need food. The beta parameter is 0.28, so in terms of the share price volatility, we're super safe. Let's go to the next one, which is the biggest, the largest grocery retailer in Canada, Loblaws. The ticker symbol is L.TO. LTO. Wow, pretty good. Loblaws consistently delivered solid comparable sales and also outstanding financial performance. I know the consumer demand right now is pretty crazy, especially in grocery business because of what's happening in the world, but Loblaws actually investing more and more money into their e-commerce solutions that has been growing like crazy for the last couple of years, so they can keep up with the demand with people who like to order their groceries online. Loblaws is the high-quality consumer defensive stock, and this valuation is actually considered cheap if you compare it to the rest of the market. And while their business model is low margin, food and pharmacy considered essential regardless of any economic conditions. I think it's an outstanding stock to add to your portfolio, especially for different types of market downturns. And Loblaws is not going anywhere. I would consider them as a monopoly because they own a ton of different businesses. They target different types of audiences with these products. They're also the largest employer in private sector. They employ around 190,000 people. Crazy. Let's take a look at their stats. So the market cap is around $24 billion. The dividend yield is around 1.93%, and they've been increasing their dividends for the last 9 years. So they're starting to become a consistent dividend-paying company. Their payout ratio is around 41%, which is pretty good. During the last 10 years, the share price grew by 117%, which is pretty good. And also, they went through last year market crash without a blip. And the beta parameter is at negative 0.09, which means that the share price moves in a different direction compared to the average stock market. In our case, the number is pretty low, so we're not expecting any crazy share price fluctuations. Alright, moving on. The next one is our favorite Canadian Tire. Have you shopped there? Probably yes. The ticker symbol is CTC.A.TO. Canadian Tire is one of the largest retailers in Canada, with more than 1,600 stores across the country. On top of that, Canadian Tire actually owns a lot of different brands under its umbrella. And over the last year, they invested pretty heavily into e-commerce solutions, so they're trying to tap into the digital market as well. And the company grew and benefited a lot over the last year because the market situation where people started to buy things online or to buy things for their home to make their offices better. But I still think right now is a great time and opportunity to invest in this company because I said so, and they will continue to grow in the future as well. Right now, Canadian Tire's share price is still 10% under its target price, so there is still room for growth, and on top of that, you're going to be paying dividends. Let's take a look at what we have from our metrics. The company's market cap is at around $11.7 billion. Their current dividend yield is at 2.5%, which is pretty generous, and moreover, they've been increasing their dividends for the last 10 years, which is pretty good. And on top of that, since 2016, they actually doubled their dividend payments. Crazy. Their payout ratio is super sustainable, is around 37%, and over the last 10 years, their share price increased by 222%, which is crazy if you think about it. The share price increasing on average 20% per year. Wow. And on top of that, you keep getting dividends. Such an amazing deal. The beta parameter is at 1.36, nothing to worry about in terms of share price volatility. And the last one for today is one of the most exciting one in terms of all kinds of parameters. It's our friend, our best one, the cheapest store, the one you go to every single day is Dollarama. The ticker symbol is DOL.TO. I like looking at stocks that everyone uses and everyone knows about. There is also some investment strategy there. If you buy something from a company, say Dollarama, you invest the same amount into that company. Say you buy a plush toy from Dollarama for $2, you invest $2 back to Dollarama. And I consider Dollarama is a bullish stock right now for a couple of reasons. With consumer spending increasing month over month and Dollarama being marked as an essential business, yeah, it's pretty essential, right? You can expect the growth from the company even more once the lockdowns are done. So it's pretty safe to invest in the company while the lockdown is there. And I think the stock's just going to be increasing more once we're back to normal. Don't get me wrong, the company had a pretty challenging first quarter in 2021, but they still have this plan that they're going to execute to add 2,000 more stores in Canada by the end of next decade. In 2022, the sales expected to increase by 10%, and their earnings expected to increase by 26%, which is crazy, and it looks very good for the future of Dollarama. And while its dividend pretty much nothing at 0.4%, the company been increasing their dividends for the last 10 years, and they decided to increase their quarterly dividend right now by 7%, which is pretty good for long-term investors that can benefit from this dividend income. Let's take a look at our metrics now, which is pretty exciting for this company. The market cap is at $17.8 billion. It's a pretty big company. They grew like crazy for the last 10 years. The current dividend yield, as just said, is at 0.4%. The payout ratio is at 10%, which is pretty good. Well, because they're not paying a lot of dividends, but they reinvest back into themselves a lot, so they're growing like crazy. And look at here, over the last 10 years, the share price grew by 1,066%. Wow, what a growth. This is crazy. The company just getting started, and I think right now is still a great time to invest in Dollarama and benefit from the growth and from the dividend growth as well. And the better parameter is 0.9, so we're not expecting any share price volatility in the short term. So that's about it from the best consumer defensive stocks. And let me know in comments if you're invested in some of those or some other stocks that you think are good in this sector, and I'm totally gonna take a look and add them into my description. Also, don't forget to subscribe to my channel if you like what I'm doing. Like this video to make it viral and everybody knows about it. Let's do it. And I'll see you around in the next video. Cheers, bye.